Hey guys, and welcome to today's session. I'm going to give people a moment to join while my desk is standing up, and then we'll jump straight in. If you haven't been to one of these sessions before, I try and keep today's session a little bit more chilled, so it's less informative and it's less kind of presentation based as opposed to our welcome sessions and our Darwin explanation sessions. I like to get you guys involved who are, sat here watching. And I like to go over somebody's Darwin if possible. But I'm also happy to kind of let you guys lead the session. We can look at different metrics. We can look at different ways to analyze a strategy and how to improve it. But what I'm noticing recently is that people like, or our viewers are liking when I kind of go off topic and we talk a little bit more about markets. So again, I'm happy to kind of deviate slightly from today's actual topic if you guys would rather talk markets, as opposed to just strictly sticking to, analyzing somebody's Darwin who's in the session. So having said that, if you want me to take a look at your Darwin, if you want me to take a look at improvements that you can do from a statistical metric, if I can speak from a statistical or metric point of view, I'm more than happy to do that. And all I will need you to do is to put your Darwin ticker in the chat, either in Discord, Instagram, Twitter, or YouTube, wherever you're watching this session, and we can go over it live. Other than that, indices, well, I say indices, the DAX has just hit an all-time high, so I'm watching that at the moment. Hopefully, I get an opportunity to go short, but I'm not going to rush into anything here. We are at weekly highs. It's all-time high. I kind of would expect a pullback, but generally when everybody or all the players in the market expect something to happen, usually does the opposite. I myself have actually pulled away from manual execution a lot recently, and I'm turning more to automated systems. So I built an expert advisor portfolio, custom built by myself, so I've coded all of the strategies, and I'm moving the majority of my trading from manual execution all straight over to automation. A few different reasons for that. I enjoy it more. I enjoy sitting down, coding strategies, running portfolios of smaller systems as opposed to just executing on one big edge. And B, I like my freedom. I like trading one or two assets from a manual perspective, which I now do in futures as opposed to CFDs. But I like the freedom. I like working for Darwinex. I like spending time with my family. I like staying away from the charts as much as possible. So I guess this is a little bit of a brief introduction to me and the changes I've been through recently. But these sessions have been imperative in that because I've analyzed so many traders' records and so many trader strategies that I kind of know en masse at this point what works, what doesn't work, and really what would work for me. So these sessions are great to kind of broaden your horizons and understand different traders' approaches to the market and maybe pick up some pointers for yourself moving forward. So I can see nobody's being brave and putting their Darwin up for review, which is absolutely fine. Like I say, I'm happy to talk markets. That's absolutely fine. However, if one of you guys does have a Darwin that they want me to look over, please pop it in the chat and I'm happy to go over that also. Usually I would prefer to have 3 months as an absolute minimum, but 6 months is preferable, just so that when I'm looking at your record, I have a good amount of data to kind of onboard, analyze, and be able to suggest changes. If it's a week old track record, it's very, very difficult to say with conviction that something needs to be changed or that something's working well or not so well. So as I mentioned, as we go through the session, please feel free to pop it in the chat. Either in Discord or any of the other channels that you're watching this on, and I'm happy to go over any of that. The portfolio that I was talking about of mine should be going live next Monday. So at the moment, I'm running 9 separate strategies. My goal is by end of June, end of July, hopefully to have about 20 separate strategies all running together in a portfolio. Now, what I do with that is I'm looking to build small bits of alpha to all run concurrently with each other to potentially make 1 to 2% return per year with a very, very small maximum drawdown over the past 10, 15 years. Now, the reason I'm doing that is rather than putting all of my eggs in one basket, which I've done my whole career as a trader, and trading one system, one strategy, however many assets that you trade, and hoping that that system has a good year, good month, good quarter, however long you want to say. I'm looking at building uncorrelated systems all trading a small bit of alpha. So if one stops working, we can remove it from the portfolio and add another one in. The reason I'm doing this is because over the past, I would say over the past 6 months, a vast majority of the best traders that I've spoken to and sat down with, interviewed, had chats with, met up with in real life, they all have a similar approach. Now, I'm not bashing or talking down on somebody who executes in a single discretionary way. It's absolutely fine, and I've done it for a lot of my career thus far. But I think for me, the part of my life where I'm at now with a young family, a good job, I'm really trying to reduce my screen time whilst keeping my exposure to the market. So again, I'm rambling on about myself. I don't really want to do that. I would rather talk about somebody who's in the audience and take a look at one of your Darwins. But again, I'm happy to answer questions about that and about why I'm kind of making that transition. I'm also just going to check that the stream's actually working elsewhere, because I think it was last week I tried and it didn't stream properly. So give me a second and I will take a look. Instagram, bang on. Let's check YouTube. YouTube, perfecto. Yeah, the stream's working on all fronts. So anyway, what I'm gonna do. Okay, perfect. I was about to start creating some questions and creating some topics. Again, I like to keep these sessions more chilled than the Tuesday and Thursday sessions. But Malcolm in the Discord has asked, can you explain what you were doing again and how many accounts you're using? Okay, so overall, at the moment, I'm trading 3 accounts. I presume you mean strategies, which I'll answer in a second. So I'm trading 2 separate futures accounts. One is with a fund, which I'm on sim for, and one is a funded account. My CFD trading is all on one Darwinex 0 account. I will eventually add more accounts to that portfolio, but at the moment it's just one account whilst I build a track record, which is with Darwinex 0. As you can see on the screen, XAQP, which for me is just a brilliant ticker. I'm happy with that one. But at the moment I have 9 separate strategies running. So each of the 9 systems are all uncorrelated systems. The majority of them are breakout, but I split them at the moment. There's systems for euro dollar, WS30, so the Dow Jones, gold, and NASDAQ. Now, there is only 4 assets at the moment, so there is some cross-pollination, I guess, between the different assets. But for example, I'm short on WS30 right now, but I can see already that one of my other systems is lining up for a long on WS30. So they do trade in an uncorrelated fashion, even though they're trading the same asset technically. So what I do is I build these systems, I test them at individual level. So I'm building a very, very simple system each time. You know, none of these 9 strategies and the 20 that I'm planning are heavily complex. And this was great advice I had from a trader that I sat down with recently, is just keep all of your systems or all of your alpha small and, you know, super, super basic. So nothing too complex. And so I build very basic strategies that work over an extended period of time and not just during a 1-month window or a 1-year window or even a 2 or 3 year window. I want something that can return 1% per year or 2% per year consistently over, you know, let's say a 5-year period. And then what I will do is I will add that to the portfolio, and hopefully that would generate 1 to 2% per year with a maximum drawdown of, again, 1 to 2% over an extended period of time. Now, because you're adding uncorrelated systems, it's very unlikely that all systems hit their maximum drawdown at any given point. So we don't just look at each system and go, well, that strategy's had a max drawdown of 1.5, 2%, 2.5%, 1%. We don't add all those percentages up and go, well, the max drawdown was 15, 20, 25%. Because again, it's unlikely that they'll hit their peak equity drawdowns at the same time. However, with the return, you can just basically add them all to get, I mean, it gets a little bit more complex when you start looking at compounding returns and that sort of thing. But you can say, well, this system returned 1% per year. This one did 2, 3, 1, 1.5. And you can add those returns up and go at the end of the year as a combined portfolio, this returns 16%. But the drawdowns would have been more you know, 1, 2, 3%. So that's kind of where my focus has shifted now, and that's what I'm building as kind of my future career as a trader. I would like to automate everything if possible, and then just make my manual executions for fun, basically. So that's what I'm doing at the moment, Malcolm. I hope that answers your question. But in terms of the how many accounts you're using, I'm just building that on one account right now. Hopefully in a year's time, I'll have investor capital through that, and some decent AUM from DarwinIA allocations, and then potentially at that point I might stick it on some funded accounts as well, and see if we can run it up that way too. My pleasure, dude. My pleasure. The problem with that is it makes it difficult to analyze your portfolio as a whole and understand what needs improvements and where you not necessarily go wrong, but what's holding you back. When you're analyzing, which we usually do in these sessions, when you're analyzing a single strategy, you can see at what point in time the strategies overperform or underperform, what sessions, what assets, etc., etc. When you're combining them all into a portfolio, it becomes really difficult to analyze at face value and just say, well, you shouldn't be doing that or you should be doing this. Malcolm said, I have 2 strategies on 2 different accounts and I found it difficult to manage both. Yeah, I mean, it depends what your day looks like. It depends what your routine's like. Me personally, I'm sat at my desk all day, every day because I work from here. So I find it easy to manage different accounts. The problem for me is manual execution takes up so much of my focus. Now, what I try and do is I try and get up earlier in the morning, do all my analysis and that sort of stuff, you know, before I even start my day, really. And I do little bits and bobs after work as well. Over the years, what I've found is I personally prefer to I prefer automated trading, right? I love manual execution, but from a standpoint of trying to build a career on top of actually building my own career, it just becomes a little bit too much, and it puts a lot of pressure onto trading, which I'm not a massive fan of. I want to trade because I enjoy trading, whereas my portfolio that does its own thing, I can schedule time to work on it, to analyze all the trades. It doesn't have to all be done in the moment. I don't have to do any decision making when, you know, I'm either with my kids or with my family or, you know, in the middle of an interview or a session like this. I don't have to make those discretionary decisions. And again, I'm not saying that's for everybody because some people like that. And I have, to a degree, over the years, I have enjoyed it. But at this point in time, I feel like removing all that, automating everything, and then just executing for fun, because that's what this is all about. We shouldn't be trading if we don't find it. If we don't find enjoyment out of it. The same with anything else in life. You shouldn't be doing it if you don't enjoy it. If you have a Darwin though, Malcolm, I'll be happy to look at it. If not, I think what we'll do, I'll grab up a random Darwin and we can take a look at some of the metrics. I also have an idea, and I'd like to get your guys' feedback on this. I have an idea that over the next few months, what I would like to do is get rid completely of these sessions. And so please give me some feedback as I'm talking through this, because I'd like to know your guys' ideas, or at least how you would feel about this. For me to get rid of these sessions completely and create Darwinex TV, where I just stream live a few times per week and run the sessions during the live streams. So for example, it might be a Tuesday and a Thursday, Darwinex TV goes live, at least in the beginning, and we can scale it up over time, where I stream for 3 or 4 hours. I run the sessions like this, but instead it's just as part of the stream. I can bring traders on, we can look at markets, we can watch the news, we can watch a market open together. Like I say, I can have guest speakers come on and do presentations or share their strategies. If I can get good traders like THA or SYO, people like this, onto Darwinex TV, give them some visibility as well. I'd like to know if you guys would find benefit in that and prefer those sort of streams as opposed to set sessions every week where I come on and do kind of a specific topic. Because what I want is I want these sessions to be as engaging as possible. Hence why today I've just come on and kind of, we're just more having a chat. I want it to be something that people come to every week and it's completely different, but you still gain value from it. So you still understand who Darwinex is, what your Darwin is about. You understand, you know, how you can benefit from trading through Darwinex Zero or Darwinex combined, right? Malcolm said, interesting perspective. Yes, I have one and one in calibration stage. What has been difficult is trading gold's volatility. Yep, I agree. My Darwin is HSNG. Awesome. Let me stop rambling then. Let's take a look at Malcolm's Darwin and see what's going down. So for those of you that are unaware, you can see and check your Darwinex Zero Darwins on Darwinex.com. Guys, a mouthful, just keep saying Darwinex. In fact, let's roll that back one further. For those of you who are aware, we have a partner company, sister company, parent company, whatever you want to called Darwinex. Now, Darwinex is a live version of Darwinex Zero. We're an FCA-regulated broker and asset manager where you can open a brokerage account and you get exposure to the Darwinex investor marketplace and also DarwinIA allocations. Darwinex Zero is a virtual rendition of Darwinex, okay? So there's a lot of cross-pollination here as well. Darwinex, Darwinex Zero, same product, same package, just different ways to pay for the service. Darwinex Zero, of course, you pay a subscription fee. Darwinex, you pay broker commissions as you would any broker account. I was actually having this conversation earlier with one of my friends and we was talking about Darwinex. And I said to him, I don't understand why any trader or every trader isn't trading through Darwinex. It's FCA regulated by the CNMV and by the FSA as well. We have deposit insurance. So traders, depending on where you are in the world, get their deposit insured. So even if something went wrong with a brokerage, your capital's insured, so you should get your money back. You automatically get exposure to DarwinIA allocations and investor capital. No other broker offers this, right? No other broker offers that. And it kind of doesn't make sense unless you're in dire need of higher leverage, which I understand some systems may need that. But if you don't need 500 to 1 leverage, if you can live with 30 to 1, I don't understand why you would trade with any other broker. And I know I'm biased because I work for Darwinex, but I genuinely don't see why you trade for any other broker other than Darwinex because you just get so much come with your account. And even if you said, well, I've traded with this broker and their conditions are better, or this broker and this happened, well, any performance fees that you would make from your DarwinIA or investor capital on top of your own money surely would pay for any of those conditions, even though Darwinex conditions are probably some of the best I've ever come across. Yes, there are some commissions that you might not have at other brokers. But again, if you're making money from investor capital or DarwinIA allocations, that should cancel out any commission that you have to pay. But anyway, enough of that. Let's move on. So Malcolm's Darwin, HSNG. So 5 months long. So since the beginning of the year, 2.39%. I mean, to be honest, dude, starting in January, I'm very forgiving this year, let's put it that way, because I've seen how many traders, including myself, who have struggled trading through 2025. The volatility for me has probably been the highest that I've experienced in my career, other than potentially Brexit and COVID. But COVID still seemed calm relative to what we've experienced this year, in my opinion. Maybe not, but that's how I feel anyway. So to come out at the other end positive is still fantastic. Absolutely fantastic. Pretty decent March. I mean, Feb and April, not too bad, but down. And then May, you seem to have recovered, giving you a 2.39% return overall, which is great. So your Darwin was created on the 22nd of March. And since then, it's been relatively flat. You've had a good month and then a little bit of drawdown. So you trade mainly commodities. It looks like you're a swing trader. I mean, how many trades is that? 19 plus 8. So 27 trades in 5 months. What's the average of that? Maybe one. Yeah, 0.27, 0.3 per day. So I would presume that you are a position or a swing trader. In fact, if we take a look at your average holding time, Yeah, so it wouldn't. This looks to me more like position trading as opposed to swing trading. Your average loser is 7 hours and 33 minutes. Your average winning trade is 1 day and 17 hours. If you was a swing trader, I'd expect that to be slightly higher. So this looks more like position trading to me. You have a 50% win rate on FX and a 42% win rate on commodities. However, even with the lower win rate, you still return or have returned much higher on commodities, which is gold. So you've only traded gold, and then you trade GBP AUD, GBP JPY, Euro USD, and Pound Dollar. That's a bit of a weird collection of FX pairs. Is there any like logic behind that? And the only reason I'm asking is because you're trading pound dollar and euro dollar, probably the two most liquid FX pairs. Then pound yen and pound Aussie. I mean, it could just be that you like those pairs, you like the way they move. But I'm just wondering if there's any sort of logic to that in terms of, oh yeah, I trade those pairs because of X, Y, Z. So Malcolm said, yes, I'm usually a swing trader, but gold has been unforgiving for swinging right now, lol, which has forced me to change a little, and I think it's affecting my performance. I mean, if you'd been swinging it long, you'd probably have done pretty well. It's as soon as you try and get in those swing positions that are going against that trend, right? Because as we've seen with indices, crypto to a degree, and now commodities as well, when they get going, they just really, really get going. So it's just, if you're a swing trader, it's literally just about being on the right side of the market. I know that's kind of a dumb statement because that's with any trader, right? You just need to be on the right side. But I think if you're trying to swing trade and you're trying to gain or be a part of a bigger move, you obviously need to be when volatility picks up, you either get paid a lot faster or you lose money a lot faster, right? Because you're on the wrong side of a big move. I'm a patient trader, but I'm an impatient person, so I look to trade any Forex pair that has volatility. And the reason why I like gold is because I can hold, but I hate slow pairs. I feel you. I mean, GBP AUD is a great pair to trade, in my opinion. It was one of my favorites before I stopped trading exotics because you've got high beta, like Aussie dollar against the pound, which I wouldn't say, the pound's not high beta. But it generally moves like one, right? The pound's quite volatile, so it's an extremely volatile pair. Euro dollar not so much, pound dollar a little bit, and pound yen is really. The only thing is here is how much attention are you giving to these FX pairs? Because as of right now, the only winning pair that you've had is GBP JPY, which is 1%, and that's over 3 trades. So it's difficult to say, but should you be doubling down on gold and potentially getting rid of FX pairs? At this point, I don't know. But this is something that I say to everybody, and it can be pretty poor advice in terms of just saying, oh, you should stop trading this asset because you've had a bad patch with it. But I always look at this and I go, okay, what's my expected value on each asset? And how do you work out your expected value? I mean, it's difficult when you don't have as much data, but I would be looking at this and saying, well, the majority of my return is coming from gold. Okay, so do I remove the other distractions, which would be the FX trading, and do I double down on gold? Or do you implement a risk barometer where you lower your risk on FX and increase your risk slightly on gold? Now, I don't mean by a dramatic amount, but what you could do is you could implement a risk barometer where 1 is a standard. If you know your expected value is higher on gold, you can slide that risk barometer up to 1.25, 1.2, 1.1, 1.5. It doesn't have to be percentage. It's just how would you say it? It's just a number on the slider. So it could be percentage. You could be trading 1.5% per trade or 1.5% of the standard risk, which could be 0.5. I'm trying not to overcomplicate it here. And then on the FX pairs where you have a lower expected value, again, it's difficult to judge right now just because of the lack of data. But if you know you have a lower expected value, should you be trading the same amount of risk or the same notional volume as you do on your higher expected value trades? I would always argue no. if you, again, and I'm open to discussions about this, right? If you guys have different opinions, please let me know. I'm always of the opinion that if you have two different setups, they have two different probabilities, and therefore you should risk differently based on each individual probability. For example, if you know that you win 30% of the time on an FX trade with an average risk to reward of 2 to 1, should you risk the same as if you know you win 40% of the time with an average risk to reward of 2.5 to 1 on gold? I wouldn't, because I know I win more on gold and I know I win more when I win. So they're completely different expected values. So I would implement a risk barometer there. I don't know if you have enough data to implement something like that right now, because you're still kind of finding your feet. This is why I like 6 months as a minimum. And you being a swing trader also makes this harder as well, because your trade frequency is far lower than what a scalper would be or an intraday trader would be. Trading time distribution. The annoying thing about this is that it says number of trades, but it actually tracks your trading decisions. So closing and opening of a trade. So it's hard for us to distinguish, okay, are you opening positions here or are you closing positions here? Only you would know that by A, knowing your system, or B, being able to review your journal. What it looks like here is that, well, it's not even what it looks like. The majority of your return is coming from the Asian session. You've lost money during the US, you've lost money during the European session, but you've made almost 4% in the Asian session. Now, you will know better than me if that's closing trades, them hitting target, or whether that's you setting pending orders that get filled in the Asian session. Only you will know that answer. But what I would do with this is I would begin looking, can you fine tune your system so that it's more active in the Asian session? And what I mean by that is, can you, if you know that you have a higher percentage of targets hit during those liquid hours or during the Asian session, can you try and extend your targets, or reduce your targets, or extend your stops, so that the majority of your trading activity is taken during that time? Again, it's very early days. It's very difficult to tell at this point, because I don't think you have enough trades or trading decisions. But this is definitely a metric that I would be monitoring. And I always advise everybody to monitor this metric, because essentially you want to be doing less work for more reward, right? So if you can cut trading hours out of your day, then Bob's your uncle. But you have to get more data on this, just so that you can make that decision. Because what I would like to do is, if I had 2 losing sessions and 1 winning session, I'd try and condense all of my trading into 1 session, if possible. Again, it's not always possible, and that's kind of dream scenario, but it's something to watch at for sure, and understand, okay, where do I take the most profit? For example, and this the best thing is, this can help with like fear of giving your profit back. If you know that you make the most of money in your Asian during the Asian session, you really shouldn't be closing your trades until you're in the Asian session. Track your maximum favorable excursion, take a look at your average, and then compare. Go through all of your trades. You don't have that many trades that it will take you too long. But if you know that the majority of your money is made during the Asian session, look at your maximum favorable excursion on trades that you close outside of the Asian session. Take a look. Would it have been better for me to hold, an extra 5-10 hours, however long it may be, to push that trade into the Asian session? If you'd closed it after, okay, could I have pulled my targets back so that I closed it within a time bracket instead of kind of a price point? Again, all these things are just random things that you can test, right? I'm not saying it's going to fix any issues you have. I'm not saying it's going to make you the best trader in the world. I'm just, this is the whole point of these sessions, is just to try and look at different variables that you might not have checked before, and to try and spitball new ideas to get the cogs whirring for you to go and test new things. Malcolm said, yes, as of late, I've been up 2% in gold, but sometimes profit, and it winds up pulling back, and I may take half of that or a little less. 2% on one trade, but wind up closing at plus 0.8. Okay, so giving a load of profit back. Again, there's a great metric that we'll take a look at in a moment, that might help you with that, right? If you know that that's a thing, if you know that's an issue, there are things that you can study, new variables that you can study that can help you overcome that, right? So sometimes the majority of time, I always say to people, the majority of time, your issues aren't fixed on the chart. There are times that they are, and where your technical system might not be working and you might be able to make a technical refinement, of course. But there's a lot of other variables that most traders ignore. And it can be something that's personal to them, you know, in their routine or their daily life. It can be something that's about their performance at a certain time of day, day of the week, etc. Which we'll move on to now, which is day of the week. And the reason why I love this metric is it can show you when and where your system under and overperforms. So, for example, if you know that if you're trading a mean reversion system, but you know that on a Friday generally makes the high or low of the week, whether it's a bullish and bearish week, should you be trading a mean reversion strategy on a Thursday evening, Friday morning, knowing that the Friday is likely to print the high of the week or the low of the week? Probably not. However, if you know that that's on a Wednesday, and a Wednesday usually forms the high or low of the week on any specific asset. And again, I'm just spitballing here. I've done research on certain assets. I know which ones generally create highs and lows on certain days. But if I'm trading a mean reversion system, I want to be trading it on the day where I know that we're probably cooling off. So on a Wednesday, if I know Wednesday generally creates, the top on a bullish week on gold, for example, I will be trading that short on Thursday because I know the top is likely in. Maybe it's in for the past, or maybe 50% of the time, 60% of the time, it forms the high of the week on a bullish week on Wednesday. So on the Thursday, I might be scouting for shorts. Whereas if I know that that's on a Friday, I don't want to get short before that Friday and probably at all in that week. I'd be looking for a continuation. So all that to say is that the return distribution by day of the week can show you if you need to take your foot off the gas on any specific day. Or again, implement a risk barometer and say, well, my strategy has a higher expected value Monday, Tuesday, Thursday, Friday, whereas on Wednesday it has a lower expected value. So what I'm going to do is reduce the risk on a Wednesday and increase the risk on a Monday, Tuesday, Thursday, Friday. Again, for trend following systems, if you manage to get into a position on a Monday, generally you're going to end up holding that position for the whole week. Because what you'll find is if you think it's going to be a bullish week, generally that move will start on a Monday and end on a Friday. Of course, there are assets that are less likely to conform to that pattern, but generally over all the assets that I've studied and got data on, that is what usually happens, right? So what you might find is your Wednesday, Thursday, Friday are less profitable purely because when you get into trades on a Monday or a Tuesday, you've got more of the week to let that trade play out. But again, this is all just ideas, or just various variables that you can go away and take a look at. Now, your days of the weeks, interestingly, is kind of similar to what I said. Your Monday through Friday, with the exclusion of Wednesday, are all green, and all pretty much there or thereabout, right? So your highest net day is Thursday with 2.33%, and your lowest green day is a Friday with plus 0.46%. Okay, but they're very similar. There's not much between those days. And then you have one day, which is your Wednesday, which is down here, minus 3%. That's exactly what I thought. I'd rather catch a trade on a Monday. Yeah, if you're swing trading, you want to be hunting for your like the earlier you can get in the week generally is better. Again, it differs depending on what asset you're trading and the outlook that you have and how tight your stops are, etc., etc. But generally, what I've found is, and I'll pull my chart on for this just so I can explain what I'm talking about, is let's say this is. Would help if that was dark. Let's say this is your trading week. Now, what I've found, and again, this isn't just me saying it. I have actual data on this. I studied it manually for a long period of time, and then I found a platform that has all this data for me. So I have, over the years, done a lot of research into this. So I'm not saying it's gospel, and you should always research for the assets that you're trading, but this is a common pattern that I found amongst many different assets. So if the week is going to be bullish, generally what we see is a low of the week formed on a Monday. Maybe it closes the opening gap from a Sunday, whatever. Maybe it touches an inverse level from the Friday, who knows? And then we start trickling about. Wednesday, we look for the continuation. Maybe have a pullback on Thursday. And then Friday generally creates a high of the week. Okay? And that is generally your bullish weekly candle, right? So your candle is going to look something like this. Whoops. No, it's not. Something like this. It would help if I was a little bit faster. So that's your bullish weekly candle, right? And that's what the pattern looks like. So again, it's kind of an going off tangent a little bit here, but this is why I like to look at this data so that I know, does it conform with what sort of strategy I'm trading. If I'm trading a trend following, I want to be trying to hunt as early as possible in the week. Okay, so if I'm expecting a bullish week, my kind of prime opportunity is down here, right? Or at least, you know, trading the inverse of, and potentially looking for a continuation here. Okay, but you're only going to know this by A, knowing your system, and B, knowing your assets and knowing what the likelihood of this is occurring. Whereas again, if I was trading a mean reversion system, and I know that Wednesday is generally gonna cause, let's get rid of that. So I think for a period of time, don't hold me to this. I'm sure it was gold or CAD yen rings a bell. There's one of them that had Wednesday often caused the high or low of the week. So what you would have is Monday, Tuesday, and then Wednesday you would come in and I would look for a mean reversion. So the week might look like this, right? So if we go, it's probably be a little doji candle. Something like do 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 do. Now, if I know that Wednesday, which is this here, is likely to cause the high of the week, let's say we have some prior highs trading over here, and we run into those, and we have failure at those highs. Oh, we've got to add magnet mode on. So we have failure at those highs. I want to be looking to get in here, short, knowing that my strategy is a mean reversion strategy, knowing that Wednesday is my highest expected value because Wednesday is where we're likely to see the trend cool off. You know, you might get people trying to short all the way up, but you know that the highest probability for this move to play out is on a Wednesday. So you can sit there with a little bit more patience, right? But should you be looking for trend continuation or trend following strategies on that day, knowing that Wednesday is the highest probability for a reversal? Probably not. So I didn't want this to turn into a technical session because I'm not the best technical trader in the world. I love it. I've been doing it a long time and I'm good. I've made, you know, a decent amount of money from doing so, but that's not what this session is about. But it's all about spitballing ideas and thinking outside of the box. And sometimes when somebody else is looking in on your strategy, it's very easy for them to pick at things and look at things from an unbiased perspective. I have it myself. I have a risk manager at the fund I trade for who sits down with me and gives me pointers, rips me apart, tells me what I do good, tells me what I do bad, and it all comes from an unbiased perspective. To me, my setups all look very similar. I know what I'm looking for. I know what I want to see. To him, he just sees numbers, and it's very easy to pick at some things and say, you should be doing this, you shouldn't be doing that. And so, yeah. Malcolm said, "This is great. This makes so much sense now. I appreciate that, dude. I hope you're taking value from this, and I hope everybody else is too. Gold has been doing exactly what you're talking about. I should have been looking for my buys on a Monday, and I would be sitting nice currently in return. Yeah, I mean, what makes it really nice? Again, I'm going to pull the chart for this. In fact, let's get gold. Let's get gold. What day is this? Thursday. Okay, that's unfortunate. Let's get rid of this. In fact, I can get rid of everything. I don't even know what that trade was. I wasn't in that. I haven't traded gold this week. So we have the Sunday opening gap here. I mean, this is a bit of a crappy one because you'd be looking for those longs on a Monday. You probably get stopped out down here, right? But then if we look at the weekly candle as of right now, the weekly candle opened here and is now up, right? Hold on. What am I doing? That's last week's open. What an idiot. What an idiot. So actually, if you take away what I was saying, so we traded into what a divvy. I thought that was I couldn't put my finger on what I'd done then. So we traded into that gap again. Is a low of the week candle. Whoop! Definitely didn't mean that. Bullish week, same difference, right? So if you was expecting a bullish week, I mean, me personally, I'd like it to close that. So that's where I'd be looking for gold to close. Okay, so I'm expecting a bullish week. A, because we've got this big open gap. B, we've got all of these highs just sat here. We've got the beginning of the gap. All of these random highs all sat here. Anybody who's short there is going to absolutely shit the bed as price starts rallying. You're going to squeeze them out. They're going to capitulate. And then we're going to see it burst up. That's how I would be reading that. Clearly not, because I had a short P&L on my chart to begin with, but I haven't traded gold in weeks. So, I mean, I don't even know what I was doing. So if we're expecting a bullish week, okay, so we're looking as early as possible in the week to try and get long. Now you can see we get an opportunity on the Monday. Again, if you're a swing trader, let's say you're trading 50% of that Sunday open gap. Maybe if you're a swing trader, you have a super wide stop like this with your target up there. Maybe you don't. Maybe you have your target, I mean, your stop slightly smaller. I definitely wouldn't be going too small on that, because again, you're just trying to time it based on day of the week, right? There's no technical pattern there apart from the gap. You kind of get another opportunity on Tuesday down here, but then we start to rally. Okay, and now Wednesday, what we're probably going to see is some form of mean reversion. Again, just based on what I know about gold and the data that I have, we'll probably see something like this, and then continuation for the rest of the week. And the high of the week will be on a Friday, probably. Again, this is just my observation, what I've seen over the years and the data that I have. So getting in as and the reason I'm saying this is because it stops you capitulating positions. Now, how many of you can sit here and tell me honestly that you would be sat, let's say you got in this position, so you had a pretty decent stop, something like this, and you was targeting there. Tell me you wouldn't be sweating as this starts to pull back here. The trade runs up right to your target, doesn't quite hit your target, starts to pull back. Who would start getting and feeling some form of I don't want to say greed, because it's not greed, but you start fearing the worst, and you start fearing that this is going to happen. Let me make another candle. I like drawing the candles on trading view. Who starts fearing that this bad boy is going to happen? Yeah. Even though your analysis is all mapped out, even though you know the probability that this is going to close, even though you know and that you highlighted at the beginning of the week that this is what you was looking for, as soon as price starts to play out, and especially with some momentum scares people, and it baffles me as to why. People start getting a little bit flaky and thinking that the whole market is about to reverse on them, right? If you're a swing trader, you need to be able to sit through these. You need to be able to sit through these and let price run to your original target. The only way that you're going to do that is if you know the data and you know the statistics behind the scenes. Things like your return distribution by day of the week. If you know that Friday is your best day, or Wednesday, for you as an example, if you was in this trade right now and you know that Wednesday is your worst day, returns wise, should you be coming out of a trade on a Wednesday? Probably not. Okay. Yeah, look for this week. You're observing correct, lol. I've studied gold for 8 years. Yeah, I mean, the market has a funny way of doing very, very simple things, and people tend to overcomplicate them. And I understand why, like, because it's so discretionary, because everybody gets given the same data. Everybody gets given the same price feeds. You know, even in a professional environment, right? Like I say, I'm on sim for a fund. Everybody has the same accounts. Everybody has the same news squawk. So we all hear the same news. Everybody has the same limits. All the infrastructure is the same. But some traders make money, some traders don't. Why is that? Well, because it's so discretionary. It's all down to the trader's approach. It's all down to how you make decisions, how you handle pressure, and so many other variables and alternatives. But going back to what I was saying at the beginning, where I'm now building a portfolio of uncorrelated strategies, I'm looking for alpha that delivers 1 to 2% a year. Not 30%, not 20%, just 1 to 2% per year. Something that is so minimal, yet effective consistently. Something you couldn't trade on its own, really. I mean, you could, but it's probably not best to, but works as part of a portfolio because simplicity is key. Too many people will be looking for, the next holy grail. Just try and find small bits of alpha that you can capitalize on consistently. For example, I hate trading breakouts from a manual perspective. I hate them. But this was actually a trade that I was in on my portfolio today, I believe. Was it today? Closed it. Gold by 3249. It's most likely going to be there. Let's 32. Well, unless it was the inside daybreak, it could have been that. With profit target of 331662 with a stop of 320504. So this was, let me check if it was the inside day. Yeah. Okay, so it's run off CFD, so it's the price is going to be slightly different, but I have an inside day break strategy. So I actually hit stop on this first, I think. I'm confused here. Sell stop. Okay. No. My inside break actually hit stop today. So when it broke, it got stopped out here. This was, I have a H12 breakout strategy. So it looks for X amount of candles or bars back on the H12 time frame, and it will trade a breakout as soon as price breaks above it. So this was the trade that it took today. I hate trading breakouts, and I would never take that as a manual trader. But I know every year, in fact, I can bring up the data here. Let me try and find it. H12 breakout. So the total return from 2018 to 2025 for that system, the one that's on the screen now, it's done 10.87% in 8 years. Okay, 7 years, 8 years, because it includes 2018. So now if you quantify that year on year average, again, it's going to be different because of compounding, but if we just go, that's 1.358%. So that's less than 2% per year from trading this with super low risk, and that has a maximum drawdown of 2.27% over that same 8-year period. Okay, so I know that I can't trade this manually, and I probably shouldn't trade it manually, but if I can get into these moves like automatically without lifting a finger as part of a portfolio, then fantastic. Has a positive expectancy, has a pretty decent win rate, if I'm not mistaken. I don't think it's crazy. Oh, my Notion's not loading. Oh, has a decent win rate, but the payoff is worthwhile. I can see, Malcolm, you've asked a question, so let me go back to that. Let me ask you this because I found it difficult. Due to Darwin following me, hello, by the way, Cypress D. Due to Darwin following me and not wanting the Darwin to drop in risk, I found it hard to swing gold because I know I should drop lots a lot, but I feel stuck in doing so because it will confuse the Darwin. So I think you mean the risk engine. For example, I usually use 100 pip stop, but right now I need to use 200 pip stop to be safe. What approach, or what should the approach be when dealing with unnormal volatility? Why do you feel stuck in doing so? Is that in terms of you're trying to adjust your stops for volatility? Is that what you're saying? So you usually trade with 100 pip stop, but due to higher volatile conditions or higher volatility conditions, you are trading with basically double the size stop. Which I presume is what you mean, but if you're doing that, I would just trade with half the trade size. Your notional value is still the same on that trade, but you won't confuse the risk engine, especially not if what you're doing is consistent. Obviously, of course, you don't want every trade to be completely different. You don't want to be trading a 1 lot, 10 lot, 5 lot, 6 lot, 10 lot, and what have you. But if you're adjusting your value based on the market, like, don't be scared to trade how you trade, is what I'm trying to say. The risk engine will learn and it will understand what you're doing over a period of time. So don't be scared to just take the best trades. That's all I can say. Don't worry about the risk. Don't try and figure out the risk engine too much, because you can go crazy and you can start chasing your tail to no avail, like you don't benefit from it. But just try and literally take the best trades that you possibly can. That's all I can say. That's literally all I can say. So going back to your Darwin, this is the chart that I was saying might help you. And already there's a couple of interesting things. So basically what this does is it measures how long you were in the market compared to how many pips that you took from the market from each trade. And it measures it on an XY axis. So you can see at the bottom is return trade of pips, or return of trade in pips, sorry, with the baseline of 0, minus 15, minus 33, 15, 33, etc., etc. So anything on the right-hand side, you made money. Anything on the left-hand side, you lost money. Now, the other axis is how long you're in the market. So the further up on the chart is how long you were in a position. Now, for you, you have a danger zone of anything that's under 1 hour. You haven't won a trade that you've been in the market for under 1 hour. So what you need is that first hour. I would be going back and looking at all of my trades, especially the losers. Is there something in that first hour of the trade that highlights that this trade has a higher percentage chance of being a loser? $1 million question, right? How do I stay out of my losers and only trade my winners? Of course, I know that's kind of, like I say, the $1 million question. But if you can reduce half of these trades, if you can find some variant or variable that is only occurring in those, let's have a look how many there is. 1, 2, 3, 4, 5, 6, 7, 8. So there's 8 trades that all lasted under 1 hour. It's not a lot of data to look at. It's not a lot of trades to look at. But if you can find something that would highlight these trades to you before you get in the market, fantastic. If there's nothing there, then there's nothing there. There's nothing that you can do about it. At least not from this variable anyway. But again, it's just something to take a look at, because your expected value until you've been in the market until you've been in the market for at least 1 hour, your expected value is 0. You haven't won a trade. And until you do, that remains at 0. So it's kind of like what I call the danger zone. You know that you have a low probability of making money until you're in the market for an hour. And then you go from 0 to you lost 2 trades between 1 to 2 hours. You lost 2, but you've won 2, 4, 5. So you've won 5 trades, lost 2. All of a sudden, your expected value shoots through the roof. Your win rate shoots through the roof. And you can see there's more squares the longer we stay in the market, whereas there's less. The majority of your losses are taken under 1 hour, right? You haven't lost a trade that you've been in for longer than one day, 8 hours. You've only won trades. Now, there is only 3, so again, it's very difficult because there is only a small amount of data. However, we have to work with what we have, right? So what you can be doing with this is you can start building. If this was flipped, you could build time-based stops, so you could come out of positions based on how long you're in the market. But this should be telling you if your trade is going well, try and swing it, try and trail your stops, try and keep it moving. Don't cut your positions too early, because this is clearly telling you the longer you're in the market, the higher expected value you have. The higher your expected value, the more money you're going to make. So try and capitalize on that. Malcolm said, I know exactly what you mean, and I've actually been looking into this and found why. In terms of this metric that we're taking a look at, like under an hour, because if that's something that you've been looking at, awesome. Again, it's something that there's not always an answer to. There's not always something that you can find, but it's always worth looking. Like any variable that you can find in your system, it's always just worth exploring. It might go nowhere. It might take you 5 minutes. It might take you 5 hours. But even if you can try and improve your strategy or try and find something, it's better than sitting there and just accepting it and saying, well, it is what it is. But I guess the message for you is just try and stay in the market for as long as you can, because the longer you're in a trade, the higher chance that you have of making money. It's clear. Your maximum excursion chart looks pretty decent, apart from this one candle here. This is the only one that's kind of a bit of an outlier. And even though you took, even though it was your biggest trade to date, the only thing that I don't like about it is that the rest of your maximum excursions are pretty, what's the word? Pretty stable, right? So let me get my little pen up. The problem with this is that when I get it up, it doesn't go away. That sounds like a really bad euphemism. No, I didn't mean it to. I have a little pen, but when I've activated it, I can't get it off my desktop. It's so annoying. So the average excursion that you have is roughly about there, right? And I would say that's pretty good. It's pretty consistent. And then you have just one trade, right? That is almost 3 times the amount of your average. Well, actually, no, it is. It's 6 times. Your average negative excursion is minus 0.45. So your average is probably actually a lot higher. So if it's 0.45, your average is actually somewhere up here, right? Then you have this huge one here. So your average excursion, minus 0.45, and your worst, which is that big candle, is minus 3. Ask yourself why that is, because there has to be an answer. Was it a technical level? Like a technical reason, sorry, that you held this trade for such drawdown? Is it that all of these trades just never went to this level of drawdown, i.e. you use the same stop for every single trade and this was just a bad trade that had worse drawdown? Or was it an emotion? And I'm not saying this is you at all. I'm just giving various reasons as to why this could be. Was it an emotional response to the market? Were you sat in a trade, you know, and you're watching your P&L go down and down and down, and you removed your stop, and therefore your trade went massively against you, massively offside, which is actually what, 6 times worse, over 6 times worse than your average? Because that's a concern, right? If you've got one trade and there's only one, which is 6 times worse or 6 times worse negative excursion than your average, that's something that I would be concerned about. And even if it's because it's looking back retrospectively, like there's nothing that you can do about it now. The trade's been done and you snagged a winner from it. Obviously, it's, you know, closed up here. So great, happy days. But you don't want that happening again, especially if it was due to a psychological reason. Okay, yeah, it was conviction I had. That's fine. Which is okay. The only thing I would say with that is, how much do you value your conviction? How big would you have let this get? And this is, I'm not asking you to give me an answer to this now. I'm just saying it's a bit of food for thought. Like, you're saying this was due to conviction, which is fair enough, but how far would you have let this candle go down? I.e., how far would you have let this trade go against you just due to your own conviction? Again, food for thought, something for you to think about. I'm not asking you to give me an answer now. Just be aware that, of course, you know, holding trades due to conviction does carry higher risk, although it did pan out in the end and it was your biggest trade today. So congratulations for that. On the flip side, positive excursion, I mean, we all trade with or we all at least try to strive for a positive risk to reward. So generally, I'm not too concerned when the targets are a little bit more sporadic, because you can probably cut trades, and then the trades that you want to let run, especially as a swing trader, of course, you're going to try and run for as long as you can. So I'm not too bothered when there's certain candles that look a little bit larger compared to these smaller candles. That's completely natural as part, you know, being a trader. Your VAR, super stable. I like it. I mean, it's been steadily increasing, but that's probably due to the volatility of gold as opposed to you increasing your risk. So the 4 components to measuring your VAR or to calculating your VAR is asset volatility. So again, as gold has increased in volatility, and pretty much every other asset on the market, generally your value at risk is going to increase because of the volatility. Trade frequency, trade duration, and position sizing are the other factors that calculate your value at risk. I would say, because it's quite a stable increase, that for you, maybe you've increased your risk slightly, but I would put this more down to the fact that gold has increased in volatility of recent months. But other than that, super stable. Don't let it get past 10 if you can. Try and keep it underneath 10 just so that it's as stable as possible, because you started around 5. You know, if it goes above 10, there's no problem. I'm not saying 10 is a bad number, but relative to where you started, where you are now, I would be going, I don't really want this to break above 10, and I'd like to try and bring it back down if you possibly can, just to keep it as stable as possible. However, having said that, you don't really need to lose too much sleep over this, because whatever you do, the risk engine will risk adjust you at Darwin level anyway. So it's not overly important. And before we finish, I usually go through all of these metrics on here, but due to the fact you don't have much data, I'm not going to go through all of them. Just because we'll be looking at things that don't really make sense. For example, the experience score, you're only scored 0.7. So again, for those of you that weren't here at the start, you can view your Darwinex Zero Darwins on Darwinex.com. You can just log in with your Darwinex Zero account, or you can create an account on Darwinex. You then search for darwinex.com/Darwin/ your 4-ticker Darwin, and then a hashtag, and it will bring you up a page like this where it shows your Darwin and shows buy zero here. Now, again, going back to what I was saying, we have these investable attributes over here, which measure you on a scale of 0 to 10 based on various different metrics. Okay. Your first one, experience, is only scored 0.7. This is purely because we cannot say for sure that this period of time or period of trading is reflective long-term of your ability as a trader. Of course, we would be stupid to say we have 5 months track record with 20 trades. This trader is going to perform like this for the next 10 years. We just don't know. So this metric literally will grow with time. Okay, you just need to keep trading and this will increase. We measure it in D periods, which again is time and trading activity. So all you need to do is just keep trading, and eventually this will grow, but there's nothing to worry about. Market correlation. If you want to go through these attributes in more depth, I would watch one of our older strategy development sessions, because I've looked at Darwin's before that's had a lot more data, and therefore I've been able to deep dive these. So I'd recommend watching one of those sessions just so that you get a little bit more value out of it. And a lot of them are already on Darwinex Zero, so we've already looked at them. For example, risk stability is your VAR chart. Loss aversion is your maximum excursion chart. Duration consistency, negative and positive return consistency, is the duration versus profit chart, but just displayed differently. The rest of it we're not going to go into now because it's more technical related, and I don't think it's worthwhile us looking at that at the moment for you specifically, just because your record is so short in length. But one that we will take a look at, because not many people know that we have it, is capacity. Now, this measures your alpha cap as a trader, or max investment as we call it, which basically measures how much capital that you can manage, okay, before A, we cut off your strategy, but B, an investor would get different results to you. OML or OMEL has said, is this with his allocation or just with Darwin? What do you mean? What do you mean by that? What metric was you talking about when you said, is this with his allocation or just with Darwin? Do you mean these attributes as a whole? Because that would be for his Darwin. But capacity measures. So what we do is we measure the toxicity flow of your trades, or toxicity flow of your orders. And what we do is we measure at what point would an investor start getting slipped based on entering during the flow of your positions, right? So we measure the slippage and the variance that your investor would experience. So you can see this first chart up here, divergence sensitivity. So I've just stuck it onto all just so that we see all of the trading activity. Now, the last time this was updated was on the 15th of May. So your Darwin on the 15th of May had returned 2.16%. Now, if on every single trade you were getting slipped 2 pips, or your investors, sorry, were getting slipped 2 pips, they would be down minus 1.04%. So there's about 3.1% difference there. Now, it's not crazy. It's not the end of the world. But of course, that is something that, you know, we have to know, as it's our asset management license on the line with investors. If we're advertising your strategy as being net positive 2.16%, you know, over the past 5 months, but investors sat there going, well, hold on a minute, I've been invested in this trader and I'm down 1%. Of course, that's our license on the line, so we can't do that. So what we do is we measure the sensitivity of the divergent sensitivity by looking at the toxicity flow of your orders, and we cut off your Darwin as soon as we know that investors are going to start getting slipped by 0.2 pips, because Again, we can't advertise your strategy to an investor knowing that they're not going to get the same fills as you. So of course I'm pretty, I'm sure that everybody at this point knows that if an investor's trying to clip the same trades with, $5 million that you are with £1,000 or $1,000 account, you're probably going to get filled instantly, whereas your investor might get slipped, might wipe out the order book completely, depending on the time of day, the asset that you're trading, and so on and so forth. So of course we try and take all of this into account. We look at the toxicity flow, we look at the liquidity at time of trading, take all this information on and go, okay, well, this investor would have been slipped X amount, so we shut it off here. Now that brings us to the next metric that I look at on this page, which is your max estimated investment. So again, your alpha cap. So at the moment, your strategy can handle $6.42 million before your investors would start to get a different return to you. Now, this is a metric that I always say, and the guys who come to these sessions on a weekly basis will know I always say this exact same thing. It's never a problem until it's a problem, or it's never an issue until it's an issue. 6.42 million, I'd be pretty happy with that personally, because it's probably going to be a couple of years at least until you run into that problem. And by that point, you might have figured out a way to expand your max investment. It's very basic stuff. There's nothing that I can say is fixes everybody's problem with this. Like if you've got a small max investment, there's nothing that I can say that fixes it for everybody. But it's things such as trading in more liquid hours, trading a higher liquid asset, trading with smaller size, staying in the market for longer. Very basic, commonsensical things that you would think. Remember, you're trying to copy your trades to a large amount of capital, and there's going to be restraints from a liquidity perspective. So that's what we're trying to measure here. So as I say, max investment that you can handle right now is 6.42 million. If that's not enough, then try and work over the next few months. And yes, it might take 6, 12, 24, couple of years, however long it takes to increase this. But just try and do it by, again, staying in the market for a little bit longer, trading higher liquid assets, not trading things like pound Aussie, for example, and focusing on gold or euro dollar. That might increase your maximum investment. But again, you might say, I'm happy with 6.5 million. There's nothing to worry about. It's completely down to you as the trader. So OML. I don't know how you pronounce that, whether it's OME or OM. Yes, this is Darwin as a whole. Anyway, guys, that brings us to the end of this session. So a little bit different. I don't usually start it like this. I don't usually bring too many charts into it. But as I say, I'm going to start testing some new things moving forward because I want to make these sessions more entertaining and enjoyable for you guys watching. So please let me know if you liked today's session in terms of being a little bit more chilled and taking a look at some charts instead of strictly looking at all the metrics and stuff. And if you found it helpful from a perspective of strategy improvement and looking at new variables and new ideas to improve your trading strategy. Malcolm said this was amazing. Thank you. I appreciate that, dude. I really do. This is actually my favorite session of the week to run, purely because again, it's a little bit freer. I get to chat to you guys, get to learn a bit more about how you trade, what you trade. Selfishly, it benefits me as a trader because I see what works for people, I see what doesn't work, and so I absorb all this information. So I genuinely love doing these sessions. So guys, I hope you all took value from this. Again, if you missed the start or you want to rewatch it, it'll be uploaded on our X account or YouTube account for you to watch whenever. Same with all of our sessions, our welcome sessions, Darwin explanation sessions, interviews, anything that you want will always be on our YouTube or Twitter. So with that, guys, I hope you have a fantastic rest of your week. We will be back tomorrow at 4 p.m. UK time for a Darwin explanation session, which is where we look at risk and value at risk and all those sorts of in-depth things on your Darwin. So feel free to join that session. And if you can't, and if you're struggling with some of those concepts, make sure you watch the recording. But other than that, have a great rest of your week. Stay safe in the markets and peace out. I will catch you in the next one.